a long-term decline in foreign demand for U.S. debt. We're in a period of long-term decline of foreign demand for U.S. debt. In other words, there's not as many people who want to lend us money as there used to be. And we've been tracking some of this. And today we had two important auctions. One was a 3-year auction. And then a couple hours later, they had a 10-year auction. The 3-year auction went poorly, and the 10-year was okay. So the 3-year went off at 11:30 this morning, and pricing at a high yield of 4.49. The auction saw a big drop from last month's. Effectively, what they expected to get versus what they actually got, there was a huge tail for what they basically want to describe here. So when you look at these numbers, especially this bold here, foreign buyers accounted for just 52.1% of the auction today. That is down from 65% from last month. And there's an average on that of 64%. And it's the lowest since June of 2022. And direct buyers, 21%. Dealers bought, in other words, the banks that run the auction themselves, the banks had to buy 26% of the auction. That's up from last month's number of 16%. And the average auction on that is, the average on that is 16%. So the dealers, the banks, were forced to buy 10% more than they usually buy because effectively there's not enough foreign buyers or weren't enough foreign buyers. The 10-year auction went slightly better. Let's take a look at those numbers. Let's see here. Where is it here? I was looking for the dealer number. The dealers here were left with 17.3%, also in touch with recent results. So in that case, it went better, but not great. Not great. It was an improvement. So a little bit better on the 10-year, but the 3-year auction was a train wreck. We are in a situation where not as many people structurally want our debt anymore. And the Wall Street Journal ran a huge article this past Sunday, why Treasury auctions have Wall Street on edge. So you hear me harping about this on any number of videos that we've talked about here. And I'm not alone in this. I mean, here's the Wall Street Journal saying we should be concerned about this. This ran, as I said, just yesterday. I want to bring up this chart from the Journal and show you how much we are borrowing. And keep in mind, as foreign demand declines, the amount that we're borrowing is going up. Look at this chart. This is Treasury issuance going back till 2012. And the pink is what we've borrowed so far this year. Now, did we have a pandemic this year? No. But when we're all done with this year, we will have borrowed more money this year than we did in 2020 when the pandemic hits. Look at the chart. We're going to borrow more money this year than we did on the year of the pandemic, testing the assumption that the sale of $20.8 trillion of new Treasury in the first 11 months is set to surpass 2020's record of just under 21 million. So we're probably going to borrow more than 21 trillion. I said million. No, it's trillion, Jack. We're going to borrow more than we did in 2020. That's insane without a pandemic. And as you can see, it went down a little bit in 21. It went down, took another step down in 22, and now we're back up. And as you can see, I mean, if we went back to, let's just say, we were ramping up there a little bit during the Trump years, and the worst year, the Trump year was, say, let's just say, the worst year pre-pandemic, we'll say, was about 12 trillion. And so this year, we're going to borrow almost double that. almost double that in an environment where fewer foreign people, foreign lenders want to give us money, where fewer people want our debt. That is not a good scenario. And next year, it's possible that we might even borrow more. Yeah, so not a good situation. When we scroll down here and look at the distribution of how we're financing all of this, with what type of terms we're financing bills, bonds, and notes. Bills being the shortest, bonds being mid, and notes being long term. Basically, what we're starting to do is skew our borrowing to the short term, and that's how do I want to say this? That could be counter to what the Fed is trying to do. When you borrow a lot on the short term, as the U.S. Treasury, that can be inflationary. And that's, of course, antithetical to what the Fed is trying to achieve. So, in a way, the manner in which the U.S. Treasury is borrowing can actually countervail what the Fed is trying to do. And that's why I've been telling you that I think that the 10-year is going to go back to 5% maybe next spring. I'm no expert, and this is not financial advice and all that other good stuff, but I am not super enthusiastic or optimistic that we're going to see mortgage rates down to 6.1% or something like that. Because of our borrowing situation that looks more dire and more dire than ever.